Keeping our eyes on the markets extending their rally this morning. Today's gains for the Dow, the largest in more than a month. So the question, of course, arises, is the summer comeback back, I should say. The S&P's up 0.75%. It was up 1.5% last week. Joining us, Mona Mahajan, US investment strategist at Allianz Global Investors, and Peter Cecchini, chief market strategy at Cantor Fitzgerald. They both join us on set. Good morning to you both. Peter, I'll start with you. I mean, clearly good gains last week, good gains today. But is it very thin volumes? And
yes,
if people were back in more meaningful ways, would that kind of be a more resounding positive?
Well, I hate for anyone to draw an analogy based on this, but it feels a lot like many summers we've seen, but especially like the summer of 2007, when we had these summer rallies that were very low volume, really no attribution for them. I think today's rally, especially in the industrials, was very technical. The Dow was at its 200-day moving average. Emerging markets, which have absolutely been pummeled for reasons I think that have been well discussed, are also bouncing today, really just on oversold conditions. So I'm hesitant to really make too much of these rallies in these low volume environments.
Mona, other sectors doing very well today is financials, top or second best performing sector. Is that something similar? Is it just a technical rally, or is this the start of something more meaningful now we've got all of those stress tests behind us?
Yeah, you know, it's interesting. This is a little bit of a follow through, I think, from Friday's strong job report. We also have seen financials lag this year badly. So financial sectors are down 4.6% versus the S&P up about 3%. You know, people were really hopeful coming into the year, given the stress test, given tax reform, given that they are levered to rising rates, that the financials could outperform. So we're actually going to look at the end of this week. We're going to see some of the big banks report earnings. We have JP Morgan on tap. We have Citi on tap. I do think that this could be a start of a little bit of a rotations into financials as we enter the second half of the year, just given some of the tailwinds they have, as we mentioned.
Peter, key for the banks is the rates outlook. What's your view on that?
Well, our outlook all year has been for a flatter yield curve, even since the election when 2s to 10 spread was at about 135. We didn't feel we'd get enough growth in inflation to make 10-year yields rise quickly enough to offset other factors, including, frankly, the ECB acting on the long end of the curve in Europe, which helps to anchor our long end, and the Fed's sort of conviction around U.S. growth and its need to raise rates. So we think we're going to have a pretty flat yield curve into the end of the year, which for banks is obviously not all that positive thing unless we see loan volumes increase, which we really haven't.
Mona, we're talking about the strength of the economy and the jobs number. We've seen strong consumer stocks so far year to date. Can that continue regardless of the trade fears?
You know, I think consumer discretionary does have room to run here. You know, a couple things we're looking at, obviously, with oil prices rising. We're looking at gasoline prices at the pump. That's not a positive for consumer. And we're also looking at just generally a later cycle environment here where we have rising rates, where we have potentially rising financial conditions. But thus far, you know, with mortgage rates still sub 5%, with oil prices still below $4 at the pump, we're actually pretty positive on the consumer in the second half of this year.
Okay, so in light of this, we talked about consumer stocks, we talked about financials. It seems to me, looking at the second half of the year, we've got a lot of potentially market-moving events taking place.
Yes.
So we've got earnings season, this whole idea of is it as good as it gets, peak earnings, then you got midterm elections, you've got these trade escalations, which could continue to escalate. And you've got the Fed. What are the big things to watch, and where do you put your money in light of all of these potential events this year?
Well, I think we're actually going to move away from trade and tariffs as the big catalyst, and we're going to move more towards earnings as the more meaningful catalyst. I think the Fed has been and will remain an important catalyst. I mean, there's a diversity in view among the Fed, whether or not an inverted yield curve matters or not. Powell thinks it doesn't matter. Bostic thinks it does matter. And so I think that will be very important. And in addition, the sort of unsung catalyst is really ECB. I think whether or not the ECB remains accommodative into the end of the year is an incredibly important factor that is not really that widely discussed.
Yeah, and I just add, you know, on the midterm election front, I think that'll be a huge one going into third and fourth quarter this year. Historically, what's happened is there's volatility going into the midterms, but then post midterms, regardless of who wins, Democrat or Republican, the uncertainty is removed, and we end up having a pretty strong rally in that back couple of months.
So it's a buying opportunity either way, the midterms.
It feels like historically it has been, and we may be setting up for that again, particularly in this technology sector, which has been now weighed down by trade wars. And if that overhangs lifted and we're going into a strong back half, it could be a buying opportunity.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.